Set it and forget it. Well, maybe you don't want to follow that strategy when it comes to a target date fund. After all, we've got the latest findings of a study out of Bank of America that analyzed the performance of target date funds since their inception back in 1994. The results may surprise you. They didn't surprise me, but they may surprise you just how poor the performance of those funds really is. Plus, we'll talk about the rising debt load of seniors. Got some terrible statistics on the amount of increase in debt that seniors are carrying for a host of reasons, right? Medical expenses, maybe you co-signed a loan for your kids or your grandkids or whatever the case may be. Big increases in the amount of debt that seniors are carrying. So we'll talk about that and some of the things that you can do today to try and improve that, to make sure that you don't fall into that same trap. Plus, hold on to your seats, if you will, or hold on to your radio dial or your podcast channel. We're going to tell folks where they can get a guaranteed interest rate of 4%. The answer on that one's going to be kind of surprising when you hear it. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris. I, of course, am your regular host, but I have to take a moment and thank my fellow certified financial fiduciaries for aptly filling in for me last week on the program. Rob Field and Christina Lamb joined and had an interesting conversation. I actually listened to the program earlier this week, and they had an interesting and fascinating conversation about some of the impacts or some of the things to be thinking about as folks retire, and particularly retire early. I thought some of their comments on some of the social and mental aspects or benefits that come with continuing to work. Just an interesting conversation that really got to the core of, I think, when people think about retirement, there's a certain level of nervousness, a certain level of concern of what that next chapter is going to be all about. And I think that's some of the things that people need to be thinking about beyond just kind of the finances. It's interesting, while I was away this past week, I actually was reading a book on kind of that topic entitled Halftime, that talks about that transition and what you want to do sort of in that that next chapter, if you will, that looks at how that retirement is going to be structured. And for many people, it's really a combination of a lot of different things. So we thank them very much for subbing in for me on the program. This week, of course, it's just me here in the Nelson Financial Planning Studios, continuing to break in the new studio here at the office that we did with the addition. So certainly another back and forth week in the markets, as we've previously stated on the program. Once the volatility raises its head and shows itself, it has a tendency to stick around for a while. So in our view, nothing terribly dramatic in terms of markets one way or the other. There's just a lot of indigestion that the economy and the markets are going to have to work through, particularly in the weeks and months ahead, due to high inflation and high interest rates. The reality is that if you've got a diversified portfolio, which I certainly hope you do, and if you're a regular listener to the program or a client of the firm, then you do have a diversified portfolio. And if you rebalance, like we were talking an awful lot during the course of last year, then you should see a bunch of holdings, particularly balanced funds, value funds, that ultimately are down less than half of what the overall markets are. And when we talk about overall markets, remember, focus on kind of more of that S&P 500, because that's a broader, in our view, a broader and more accurate reflection of the broad-based market, if you will. If you're looking at the NASDAQ, that's very tech heavy, and the declines there have been much more dramatic. So hopefully you weren't over concentrated on that side of the equation. But the reality is, with a diversified portfolio, I think this is one of the things for folks to be thinking about, is try not to look, and I think this is human nature, so I get it, but we typically look at the top line, the total value, right? And I think it's important to really kind of take a moment, particularly in today's world, because you really do have very different performance of different asset classes that's going on out there today. But probably one of the biggest divergence among growth versus value or dividend paying companies than we've seen probably in maybe 15 plus years. And so if you take a moment and drill down into the individual positions that you have in your portfolio, you should see a chunk, maybe it's a third or maybe even half, that if they're dividend paying funds, value funds, balance funds, things like that, okay, I'm down, but maybe I'm only down 3, 4, 5, 6% relative to a market that's down 13, 14% at the end of the day. You definitely should have some positions that help. That's the point of a diversified portfolio, right? That not everything is performing exactly the same at the same time. Different things performing differently at different times. So just some comments there in terms of the overall markets, the economy, and sort of where we are. Hard to believe we're getting close to the turn, if you will, for the year 2022 coming up here as the month of June is halfway through, and when the month ends, then we'll be officially in the back half of next of the year 2022. So that's why here at the office for our clients, we're doing a conference call. I think it's on the 25th of this month, so it's coming up, where we're doing a little bit of a mid-year kind of check and a look ahead to the back half. Got a lot going on in the back half of the year when you think about it, right? You got some elections, I think, right? There's elections coming up? Yeah, there are some elections coming up. So much to say about that in the future. So back to the topic at the top of the hour. Where can you get a savings rate today that is guaranteed and literally double the current rates of what you can get on your checking account, savings account, bank accounts, things like that? Well, the answer, it's going to surprise you. Do you know who it is? Do you know who's paying? And it's guaranteed by the government. Do you know who is paying a rate that's approximately double what the prevailing rates are? Why, it's the IRS, the Internal Revenue Service. When we get back from the break, we're going to talk about this one. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So where can you find an interest rate, guaranteed interest rate, backed by the federal government that is double what you can get on your bank accounts, your checking accounts, your money market accounts? Why? The answer is it's the IRS, the Internal Revenue Service. That's right, that may surprise you, but the IRS is paying current interest rates at 4%. I kid you not, that's the current rate. That's the effective rate starting this past April. So what's the catch? Well, there's a little bit of a catch here. We'll get into that. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Centrifuller's longest running radio program, also one of the top 25 financial planning podcasts out there in the podcast world. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries, like our hosts from last week, Rob Field and Christina Lamb, who subbed in for me. We certainly appreciate that. Joined the program. We've got a team of folks just like them. They're all certified financial fiduciaries at the office at Nelson Financial Planning. So if you're interested in having one of them help you change your life, give them a call this coming week and see if they can have a conversation that might make some better sense of your finances. So what's the catch? So here's the tease, right? I mean, I've been doing this long enough to know, you gotta tease the topic, right? So the topic, the fact that the Internal Revenue Service pays an interest rate of 4% effective starting this past April. What's the catch and how does it work? Well, the catch is that the IRS has to be sitting on your refund, right? That's kind of the catch, meaning that if you are owed a refund and it is taking the IRS too long to give it to you, to return it to you, then you actually collect interest. If you're a regular listener to the program, you know that I was waiting for my refund probably about 6 months, and yes, indeed, they sent me some interest, a higher level of interest, certainly, than what I would have gotten if that money was sitting in the bank. Now, I'm not sure I'm advocating overpaying your taxes so you can sit on refunds with the IRS, but the reality is that in today's world, it's quite common to find that the IRS is sitting on a refund because, after all, it's sitting on north of 20 million tax returns that it is behind in terms of the process, right? Here's how it works. When you file your tax return, generally the IRS has 45 days in which to process it and pay a refund. After that, the interest starts accruing, and that is tied to the current interest rate, the current short-term interest rate. And so the interest rate, obviously, on the Treasury has gone up. That's driving the interest rate of which the IRS is obligated by law to pay. Difference is that your bank is not obligated by law to pay you said higher interest rate, but the IRS is. Now, downside, yes, that interest is taxable as income, just as it would be if it was interest from your bank, but certainly some interesting numbers in terms of that high level of interest that the IRS pays. So, how much are we talking about? How much should I be concerned as a taxpayer that the good old IRS is paying out such a high level of interest? How much does it amount to? Well, I think this is where the numbers are going to kind of surprise you. Certainly surprised me. For the fiscal year 2021, the IRS paid $3.3 billion in interest, largely because of the volume of delayed returns. The reality is, if the IRS is paying interest, that is a cost to all of us as Americans, because ultimately that's money coming out of the government coffers, right? So if they're so far behind on the returns to the point where they have to pay out a total of $3.3 billion in a fiscal year, that's a lot of money. By comparison, that amount of interest that the IRS paid was 3x what it paid for interest just 5 years prior in the year 2015. So therein lies the problem. Good news, bad news, right? Hey, I can get a guaranteed interest rate. The catch is I got to have a refund. The real problem, though, is that as taxpayers, as Americans paying taxes, well, that's a cost that should be avoided if the IRS was not quite so far behind. Nearly 10 million of unprocessed tax returns still from the year 2020 and 2021. To put it into perspective, that $3.3 billion that it paid, that's about a quarter of what it costs to run the IRS in a year. That's a lot of money. What's even worse in terms of these numbers is that the IRS basically just kind of shrugs it off. The exact quote from the IRS on this particular issue: "We don't believe that the amount of interest paid is reliable or a meaningful business measure." It measures something, and if you're paying out twice as much interest as what you previously did, or excuse me, 3 times as much interest as what you previously did, well then perhaps you need to clear the deck of some of these unprocessed tax returns and not have to pay quite so much, because what you're paying is dollars that Americans paid in taxes. If you think that's ugly, we'll shift gears on to the next topic, because we're going to continue the theme of the IRS and paying money out along that comes with the latest audit by the folks at the Treasury Inspector General for Tax Administration. The Treasury Inspector General for Tax Administration audit focused on this processing issue of stimulus checks and claims for the 2021 filing season. Here are the sad numbers. According to the Treasury Inspector General for Tax Administration, 181,743, that's a pretty exact number, returns due to programming and timing issues resulted in incorrect stimulus checks given out. On top of that, there was another 355,015 individuals that were erroneously issued stimulus checks. All told, if you're keeping score, and you should be because you're a taxpayer funding all this craziness, nearly 900 million, that's about $1 billion, give or take, in potentially improper stimulus checks that were paid out, issuing over 500,000 wrong stimulus checks for a total of nearly $1 billion. The IRS response to the audit from the Treasury Inspector General, they declined to review the improper payment and to take actions necessary to recover. Folks, that is just shameful. Government waste is shocking. The lack of baseline good habits, good processing habits, good ways to run a business is lacking dramatically within our federal government system, and some could argue state and local as well. But the real issue is it's at taxpayer expense. Current budget of the IRS about $13 billion, and making about $1 billion of mistakes in terms of stimulus checks and paying out another $3 billion of interest. That's some rough numbers. I don't care what side of the political equation you are on, those are ugly looking numbers. Now, the reality is it's not that you throw more money at the agency, it is that in fact you improve how they are doing, because clearly something is wrong in terms of how they are doing their business, because that's a massive cost to the taxpayer, or nearly over $4 billion alone based upon incorrect stimulus checks and interest paid. Pretty ugly scenario when you think about it. Anyway, we're going to shift gears and we'll talk about set it and forget it and the world of target date funds when we return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back. Set it and forget it, right? That's the message when it comes to target date funds. That may not be a good idea when you start to look at some of the numbers and some of the data that's coming out on target date funds these days. You've certainly heard it here before. We've certainly never been big fans of these target date funds. It just seemed like they just were too generic, too general to really accomplish what investors need over time. And now there continues to be more and more data on them to back up that contention. So we're going to give you the latest data and their performance, and more importantly, we're going to drill down a little bit and reveal why that performance is lagging as much as it is. So welcome to the program here. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. I one of Central Florida's longest running radio programs, also coming to you on a host of radio stations, and then over on the podcast universe, one of the top 25 financial planning podcasts, over 20,000 downloads. I think we're actually over like 22,000 downloads now of our program. If you're interested in subscribing to our podcast platform or even our YouTube channel, just check us out on those particular platforms. Search for Nelson Financial Planning, search for Dollars and Cents, search for Joel Garris, and you'll find our channel. If for some reason you can't, go to our website, upper right-hand corner. You'll see all the magical little icons. Click on the one that looks most familiar, and poof, you will be instantly redirected to our channel on those platforms. So my name, of course, is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, where our team of Certified Financial Fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So 401ks basically dominate the landscape in terms of where retirement assets are. Nearly 70% of all retirement assets are held inside of 401ks. That is double the share that these plans had from 1980. Clearly, the vast majority, well over 2/3 of all retirement assets held in 401ks. That's a pretty staggering number when you stop and think about it. The reality is that employers want easy button solutions so that they don't have to answer a bunch of questions from their employees, and also to reduce liability. And I think that last piece is perhaps the biggest reason why target date funds were created in the first place. So in 1994, give or take, target date funds were rolled out. They were billed as simple to use, easy to understand, and yeah, at the end of the day, I think they certainly accomplished that. But just because something is easy to understand and simple to use doesn't make it the best possible option for your investments. The question when it comes to picking a target date fund is the simple question of, well, tell me your birthday. Tell me your birthday, and I will tell you exactly which target date fund you need to be in. Really, if only it were that simple. But the world, and certainly 401k platforms, has certainly been sold on that concept. Well, now here comes a new report from the folks at Bank of America calculating the performance for a 2040 target date fund since its inception in 1994. So if you think of it, a 2040 fund would be a fund, particularly throughout, like the 90s and the 2000s, where it would be a number of years away. So that would be typically the fund that someone would have picked to have their money invested in, particularly if you were in your 30s in the year 2000, right? You're retiring at 70, you would pick the 2040 fund. I mean, these are the 2040 fund would be the fund that you would be most likely to pick because it's far enough out, which if you're in your 20s and 30s, that would typically be the fund that you would have been picking at that point in time, particularly because those target date funds, the date on them obviously means, okay, well, that's the date that I've circled in terms of my potential retirement. So looking at the performance of those 2040 target date funds since 1994, the year of sort of their inception, the reality is that what was determined is that the performance in fact trailed the S&P 500, that broad-based market index that we like to kind of think of as a good measure of the markets themselves, trailed the S&P 500 by 2.4% per year over, what is that, 94 to 2020, 26-year period of time. That's a big drag if you're trailing performance by nearly 2.5%. In isolation, I suppose that's somewhat understandable that it would trail the overall markets, because after all, 2040 fund, target date fund, would typically have about 80% stocks, 20% bonds. So there's a little bit of an explanation. But the study further found that the risk profile for the 2040 target date fund universe and the S&P 500, the broad-based market without any bond component, was basically exactly the same. So you're getting less return for the same level of risk. That's not a good trade-off. The reality is that, in fact, a simple 60-40, 60% stock, 40% bond mix provided higher returns with lower volatility than grabbing some target date funds. So what's going on? How could this be possible based upon an investment product that's designed to sort of be this quote unquote glide path based upon your projected date of when you want to retire? Well, there's three things at work. So here's the issues behind what the performance problems are with these target date funds. So this is the big reveal, if you will, in three parts. First of all, target date funds typically will be quite heavy on the international side of things. Now, don't get me wrong. I'm all for having a diversified portfolio, to have some portion of that portfolio be in companies that are headquartered outside the U.S. I'm not so small-minded to think that, oh, the only thing you should own is U.S. companies. The reality is there's a lot of great companies that are headquartered outside the U.S. that, at the end of the day, are global leaders in their particular industries. So yes, have a portion of your portfolio on the international side. Maybe that's 20, maybe that's 25%. But typically a target date fund has about 40% allocated to the international side. We think that's a little bit high, particularly relative to the performance of most international asset classes in relation to U.S. performance. So number one on the sort of the reveal behind what's going on behind the curtains of these target date funds, generally the international component or the percentage of money that's invested on the international side is a little bit higher than what you would typically expect to see. That certainly has been a drag on performance, especially with 40% on the international side. Number two, there's this assumption that bonds behave in downturns. And while that's mostly true, sometimes it's not. Case in point, the year 2022. We've got rising interest rates that are rising pretty dramatically, sending most bonds and bond funds down in value, in some cases almost as much as the overall markets themselves, particularly if you're looking at muni bonds, corporate bonds, or longer term bonds. And then number three, the other issue on target date funds is that they can sometimes be a little bit too rigid on the rebalancing. And by that we mean that they constantly rebalance every quarter. At the end of the day, though, sometimes it's good to kind of let things run, right? Look at the past 5 years. If you let your large tech stuff run for a little bit, then obviously you were rewarded with a much better return. Case in point, certainly you want to rebalance, no question at all on that, but I think too active of a rebalancing every 3 months, things like that, can actually serve to reduce down the performance. So those are the issues with your target date funds. We'll continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We've got the latest debt numbers in this segment of Dollars and Cents, the latest debt numbers for seniors, and it is disturbing. So we thought we would spend this last segment of the program talking about some strategies to maybe assist folks on getting on top of their debt. So welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life with a successful and cost-effective financial plan. So give them a call this week at the office. So here are the numbers. Debt in retirement. These numbers come to us courtesy of an article out of one of the many trade publications that we read on a regular basis. Debt in retirement. Debt has become a growing element in retirement, unlike the past. Seniors are now carrying more debt into their later years than ever before. This, of course, has had a substantial draining effect, as it might very well have, right? If you got to make the payment, then it's got to come from somewhere. It's got a draining effect on savings, it's got a draining effect on income, it's got a draining effect on investments as they pay interest and continue to carry and service these liabilities. So here are the statistics, here are the numbers. 44% of Americans aged 60 to 70 carry a mortgage into retirement. That's nearly half. That's pretty surprising. That is a 471% increase in debt level for those age 60 and over the last decade. What is surprising about that, if you stop and think about that, last decade has been a pretty good decade in terms of investment performance. Last decade has been a pretty good decade in terms of appreciation of real estate values. But yet, you've got a 471% increase in the debt level of those folks that are over 60 and above. Pretty dramatic stuff. The average debt for those age 56 to 74, $96,945. So about 100 grand, give or take. The average debt, if you are over 75, still pretty good number, over $40,000 is the average debt for those over age 75. Why? Well, I think it's a combination of a lot of things, right? Housing, school loans, medical bills, all of those certainly can come into play and generate debt that it's hard to get out from under. So, but these are certainly some pretty disturbing statistics when it comes to debt in retirement. 471%. Golly, that's just staggering. 471% increase in debt level for those age 60 and over the past decade. So, what to do and what you should be doing to avoid that, right? Because that's a major drag. If you've got to pay a mortgage, if you've got to pay credit cards, if you've got to pay a student loan, whatever the case may be, and you're sitting in retirement, then those dollars are clearly going to pay the debt, service the debt, pay the interest, all those kinds of things. And at the end of the day, it doesn't actually really help you have fun in retirement. Because after all, that's sort of a purpose, right? If, you retired to have some fun, then having fun usually takes money. M-O-N-E-Y, as my late father-in-law Jack Nelson used to spell it out on a regular basis. M-O-N-E-Y. That's, after all, what you need to enjoy things. But if it's going to pay debt, well, then that's not really enjoying things. Because after all, debt represents sins of the past, right? That is, when you have debt, that's money that you've spent previously. That's not money that you're spending today. So, what does it look like? How do you do it? How do you get a plan and not ignore it? Because that's the most important thing, right? I mean, you got to get a plan, you got to figure it out, you got to sit it down and not ignore it. So what does that look like? Well, we got three kind of steps to be thinking about when it comes to that. First and foremost, get the actual amounts, right? I think far too often people think, oh, I've got X amount of debt. And the reality is that human nature, you probably underestimate what you have. So get the actual amounts, get the interest rates. Don't just guess, pull up the statements, look at the statements, verify the numbers. And that's the first step in the process. And then number two, create a spreadsheet. Now, if you're not a computer savvy person, don't worry about it. The good old-fashioned pencil and paper still works just like it always has. But at the end of the day, sitting down and putting all of that on paper and organizing it in such a way as you can kind of see that overall picture is imperative. So make sure you're sitting down and sketching that out in some kind of a spreadsheet form, right? Who you owe, the amount you owe, the interest rate you're paying, and the amount of money that you're paying on a monthly basis. Those are the key pieces of data to capture when you're kind of doing the spreadsheet analysis of that debt. So once you've done all of that, once you've got the actual amounts, once you put it on a spreadsheet and kind of got it documented, then you start to break down what you're going to tackle first. Tackle the highest interest rate first, combine that with what's the smallest amount that you owe. And this is where you kind of start talking about that whole debt snowball effect that Dave Ramsey always likes to talk about, which is that look at the amounts that you owe and then look at the interest rates. Oftentimes what people will talk about is pay off the smallest amount of debt that you have, and then that creates a little bit of a debt snowball. I like to kind of tweak that a little bit and also layer in, okay, well, that's fine, but if I've got one debt that's costing me 20% and another debt that's costing me 5%, I may want to spend a little bit of time focusing on that debt that's costing me 20%. The reality is that that's what you then need to start to look at. Lastly on that, you got to tackle it, maybe even use some of the cash savings, right? If you've got cash savings that's sitting there, and obviously we don't want to see cash savings and emergency savings drains down so low that you don't have money that you can use in the event of an emergency. But let's face it, cash sitting is making nothing. If I've got debt that's costing me 8% or 15% or 20%, seems like an easy analysis, right? Go ahead and take some of that cash and pay that debt off, because you're just losing financially on that to a great extent. And maybe even you go so far, depending upon how bad a shape the debt picture side is in, to look at some of the investment side and say, okay, well, maybe I'll take a little bit off the investments. Even now, even though there's been some market volatility, at the end of the day, if you've got debt that's costing 18%, your investments aren't going to make that. It's not going to happen over time. So the reality is, why not even use some of that? So look at that whole picture in terms of getting the debt on track. Make sure you're looking at that overall picture. The good news is, if you're still a few years from retirement, then you can certainly set things up to pay them off over time. If you are in retirement, then you really got to kind of dig into this analysis pretty deeply. Really look at those numbers. Anyway, we're going to wrap it up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.